Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report coming to you from down here in Central Florida again this week. What started out as a beautiful day earlier has turned into something of a little bit of a rainy afternoon as we get our usual line of thunderstorms moving over. So anyway, it's been actually a plus week for the stock market. The S&P 500 was up 3/10 here in the United States. Not quite as pleasant around the world as the all-world URTH ETF, which is based on the MSCI indexes, dropped about 8/10 on the week. And our community bank index that we track, QABA, was up about 6/10 on the week. So not a bad week for stocks. A lot of merger arb pain earlier in the week as a couple big deals fell apart, as you know, but not hearing any talk of severe margin calls or ARB funds going out of business. So apparently these guys had this stuff hedged pretty well, and we'll just move forward. Um, Russia and the United States spent some more time throwing back and forth sanctions and import food bans, and all of that can have disastrous economic consequences for both sides going down the road. But the world did not, in fact, blow up or break out into World War III during the week, and interest rates are still very low. So the stock market decline has decided to take a little bit of a pause for now. The world this week's pretty much the same. I mean, the new addition, of course, is that now we have U.S. planes bombing ISIL forces in Iraq, and by all accounts, the situation in Iraq is just horrible. ISIL is committing something that's pretty much akin to genocide at this point. There's some very real fears that we will get drugged back into the mess Iraq has dissolved into since our troops left. Let's hope not. There probably is not a fix in that region involving the United States and our military forces. And it would just be another severe economic drain and a waste of American boots on the ground and potentially lives. So let's hope that we can contain ISIL without having to get drug into this any further. That would be quite a mess. We have Israel and Hamas, I guess, have just come to a new truce this afternoon. They're going to extend that for 72 hours. And then if they behave like they've behaved all along, Hamas will start lobbing some rockets back over and we'll just be right back into this thing. The situation is still very much touch and go. We'll see if any negotiations actually take place over the next few days. And, of course, Russian troops have wrapped up their exercises and are said to have pulled back from the border. However, the fighting in the Ukraine does still go on as we sit here now. There is apparently a battle raging with quite a bit of bombing going on. So that situation is still touch and go. It's been one of my fears. It got played out a little bit over the last couple of weeks. There are enormous economic consequences for both sides of a prolonged dispute between Russia and Ukraine in the West. That could get quite messy. We're still watching it. It's one of our major geopolitical concerns. Didn't have a lot of economic news moving the market around last week. Bank of America got their settlement with the Department of Justice, and they were allowed to raise their dividends. So I guess that's a good thing for Bank of America going forward. They're starting to get their act together. I sure would love to be in their boardroom when they sit around and talk about those decisions to have bought Countrywide Mortgage and Merrill Lynch back when this crisis started, because it really has not worked out too well for those fellas. Anyway, the S&P is still, in spite of all this turmoil, it's only about 2.92% off the 52-week and all-time highs. There is a school of thought out there that is reminding us almost daily, hey, the S&P looks good and it's been strong, but there's this rotational bear market going on. A lot of individual names and sectors have really been hit. So, don't pay so much attention to those major indexes. Let's look at this rotational bear market that's going on. So I decided let's break out the tools, do a little math, use the screener, see what we come up with. So here's what we came up with. We had 7,640 U.S. stocks in my little database, okay? And 1,692 of them are, in fact, over the last 6 months down 20% or more. Now, 20% is what we all consider bear market territory. So we'll say that these stocks might, in fact, be having a rotational bear market. But let's dig deeper. Is it creating any additional safe and cheap stocks? Is this an inventory creation event that we've just missed because we're so focused on the indexes? Because everybody knows I'm such an index-focused kind of guy. But here's what we found, all right? When we broke it down, of those stocks that have dropped 20% in the last 6 months or so, 77, a whopping total of 77 of those stocks are trading below book value. So the rest of those stocks, the more than 1,600 stocks, are not value bargains. They're just stocks that have gone down in price a little bit for whatever reason, but it's not an inventory creation event from our point of view at this point in time. If we just keep going deeper and we use my basic safe and cheap metrics, of those 77, we've got exactly 24 that would pass just my initial credit screens. So mine are pretty stringent. So let's use somebody else's. We'll take the 77 stocks. Let's see how many pass with a good, solid Piotrowski S score and might have the potential to be market beating stocks over the next couple years. There's 10. That's all. Just 10 stocks that are down 20%, trade below book value, and have a Piotrowski F score of 6 or higher. So there's no real bargains there to be found either. So let's go back, look at the 77. We'll break out the Altman Z score. So we'll see which ones have an Altman Z score of 3 or higher, indicating that this is a company with a almost bulletproof balance sheet and should actually improve and do better over the next couple years. We got 12. So still, we're just not getting, this is not a massive inventory creation event on any scale. Yeah, a lot of stocks have gone down. Some sectors have gone down. Most notably, by the way, this list and all categories that I just mentioned are dominated by mining and energy stocks. So if there's any inventory being created, it's in those sectors. We already own most of the stuff that is down in value this year and has solid financials and fundamentals. So nothing much to do there. Now, some other guys, and I use the metric as well, some other guys say, well, look, let's use enterprise value to EBITDA. That's a great measure. The private equity guys use it in their search for value all the time, and it has been proven to perform pretty daggone well over the last 40 or 50 years as a way of picking potentially winning value stocks. It's a little better. When I take my 1,692 stocks that are down 20% or more, I do find 36 stocks that trade for less than 5 times enterprise value to EBITDA. I always use 5 as my upper cutoff for one simple reason. One of the smartest, most successful private equity investors I've ever met in my life shared with me over drinks back at Red Eye's Dock Bar in Maryland one day that was the cutoff his firm had used to rack up some unbelievably impressive returns over the years. Made a lot of sense to me. That's a 20% EBITDA yield on the total value of the company. So that's always been a good cutoff point for me. I'm going to be generous, though. I'm going to go to the bottom decile, the bottom 10%, which some folks have told me also works pretty well. And that's about 7 to 7.5 enterprise value to EBITDA right now. So let's see how many of our 1,692 stocks would be cheap in the bottom decile of that valuation metric. Yeah, we got 54. And again, the list is dominated by energy and mining related companies. And when we go up and we go to the 7 times EV to EBITDA, we do start to bring in quite a few retailers into the mix that have just been falling down. And I'm not sure the results going forward, that multiple could go up because the results at the ones that are on the list are actually pretty bad. So this rotational bear market that we're hearing about is not, there's some going on. Certainly, you've got 1,692 stocks that are down 20%, but no real value is being created. After a 5-year market advance, they're falling from such lofty levels that they're just absolutely not at bargains by any stretch of the imagination. Still not a lot of safe and cheap stocks out there. So the mantra has to be, look, we've got to be selective. We've got to be careful. Discipline here calls for holding a lot of cash if you're putting new money to work, because there's simply not enough stuff to buy to justify being fully invested right now. I wish there were. Nobody loves a good bear market party more than me, but hasn't happened yet. And I looked over that list of 1,692 stocks, and when you look at the larger ones on there, it's Twitter, it's Sprint after the deal fell through this week, it's Whole Food Markets, Pandora, Yelp, Nu Skin. They may be down 20%. They can go down another 50%. They're still not going to be bargain issues. This rotational bear market, take that with a huge grain of salt and stick with the absolutes. Are there safe and cheap stocks? The answer is Not very many, so let's be careful. So anyway, the day did start off beautiful down here, and we got up early, something I don't usually do on a Sunday morning. I'm more of a sleep in and get a brunch kind of guy, but we went over to the water park. We went to Typhoon Lagoon. I absolutely love that place. Wave pool is tremendous. Knocks this old guy around pretty big as they throw that 6 or 7 or 8 foot wave or whatever it is at you. Rode a few rides, had a great time, and got home in plenty of time to avoid the afternoon thunderstorms. But now, Disney is a company I want to talk about today because Disney is a great example of deep value investing at work. Now, in 2009, before I met my now wife Erin, my adult kids and I came down on pretty much a whim to Disney. My son was 21, my daughter was 25 at the time. We came down, had just 4 fantastic days. If you remember, now we came down in late February 2009. So the bear market's been raging. Things are just horrible everywhere. People are ready to jump out of windows. Fortunes have been lost. Here I am wandering around Disney World. Well, because I had been very nervous and really didn't start getting my money back in until late 2008 and 2009, after starting to pull back quite a bit in 2007. I was still in pretty good shape. And we got to Disney, and I noticed that, the company was this is one of the most efficient companies in the world. I did a little test. It was a terrible little test. Never should have done it. Smoked a cigarette, dropped it on the ground, left the butt, stood back to see how long it took them to clean it up. It was 2.5 minutes. Boom, gone, done. If you've ever been to Disney, you know that the parks, for the amount of people that flow through there, are incredibly well maintained and clean. It's just a neat thing to watch these folks at work and the efficiency with which the companies run. But I noticed, look, there were still plenty of people there. There were lots of foreign folks from both Europe, Brazil, Japan were coming to the park. There were still plenty of U.S. citizens. They were selling, lots of Mickey Mouse hats, ears. They were selling Coca-Colas. They were selling food. People were riding rides. Wasn't as crowded, perhaps, as back in 2006, 2007, but there was still a lot of people there. So we got back. I did a little exercise, and I sat down with the Disney 10Qs and 10Ks, and I went through it, and I added everything up, and I spent a lot of time with this one. And what I found was that at the then price of about $17 a share, Disney was trading for less than what any reasonable estimate of just the land and the buildings were worth. And at the same time, they were still generating billions of dollars of cash flow. The world was in panic mode. Disney was trading at 17. I came up with the lowest valuation was 39. My top was 45. Okay. So the stock was trading at this huge discount. Wasn't a discount to book value, but it was certainly a huge discount to what any rational person could come up with, because they'd loaned so much of that land for so long that it was severely undervalued, to say nothing of like a 3 multiple, I think, at the time, being put on the cash flow that this company was generating. It was crazy. Added it all up, it was worth at least $40 a share. So I started buying some stock. Deep value investing at work. Nobody else wanted these stocks. We were in a severe recession, a credit crisis. Nobody was ever going to the amusement park again. The economy was going to collapse. The world was going to end. You didn't want to own stocks, and you sure did not want to own shares of a company that is discretionary spending dependent as Disney. Okay, but as we know, it all worked out. Disney is, like, after that great earnings report, it's up in the 80s now. So if you had bought Disney when I did back then, and we looked, it's right there in the first week of March, paid 17 and change for the stock. If you held it through today, you've done pretty daggone well. You've got a 38% compounded rate of return. That's just phenomenal, but no matter how you cut it, that makes up for a lot of time sitting in cash waiting for stocks to collapse. Okay, remember, that's 3 times the market's long-term rate of return. You could just have held Disney for this period of time in cash for 5 years before and 5 years after, and you'd still have a market-beating return. Now, do I still own the stock? No, I've always sold too soon throughout my entire career. When it came up to my rational valuation level in 2012, I started peeling off the shares at about 42. I think the highest I sold any for was 45. But when I go back and I look from 2009 to 2012 on that one position, I had a compound rate of return of 35%. Now, the dividend yield on the cost, for those of you that, by the way, that if you bought it back then and still are fortunate enough to own it, your yield on cost is about 5.75%. That's a little bit better than T-bills and CDs and treasuries are paying today. Deep value at work. You sit, you wait for the bargains to be created. It doesn't happen on my time frame. My time frame would have been yesterday. We could have all this cash invested and be having a lot more fun. But the bargains will be created. If we look at some of the sectors that have sold off, coal has been decimated, and it's kind of, got that same thing. Nobody's ever going to use coal again. China has laughably said they're going to stop using coal in the Beijing district by 2020. Well, even if they stop in that district, that's a small fraction of the country. Emerging markets are going to burn coal. Coal is not going away. Peabody Coal is absolutely the best coal company in the industry. They're certainly going to be a survivor. They're going to adapt to the new realities. We're still going to have substantial electricity generation from coal here in the United States, and they'll just start exporting more as time goes by. Stocks at 1x book value, if it got to 80 times book value, you'd have to look at that company and say, we should buy this and hold it for the next 4 or 5 years, because even though the picture's not pretty right now, it's probably going to get a lot better. So the same thing for steel companies. Economy's slow all over the world. There's excess supply is still, and capacity is still an issue. That's not going to stay that way forever, guys. The economy is going to get better. Worst case scenario, all of this blows up into a world war. I got news for you. That's fantastic for steel companies. Best steel company in the world right now, in my opinion, is ArcelorMittal, MT, trading at a huge discount to tangible book value. I own that one. I've owned it for a year. I'm up a little tiny bit in it. I expect to be up a whole big, great bunch by the time this all plays out. Might be 4 or 5 years from now. Maybe it'll be a year or two. I don't know. Deep value at work. Where are the real bargains that can survive until business thrives again, and they do just as well as Disney did and rack up those annualized gains of 30% or more for long-term shareholders? That's kind of the mindset that you have to bring to the market. It's what our friend Mr. Womack, the pig farmer, used to never have a losing money in the stock market. It's what Hetty Green used to become the richest woman in the world back in the day. And it's why Andy Beal of Beal Bank has been such a huge success and made so much money. They don't do anything until there's something to do. Right now, there's not very much to do, so that's kind of what we're sticking with. But think long term, look for where nobody else wants to be, and stocks are truly cheap right now, like Disney was back in 2009. So that's kind of the mindset we need to have. All right, so we're wrapping things up here. We're sitting here, and again, we get to use that phrase, first place Baltimore Orioles. This team is hot. They have won 7 of their last 10 games. We got a wrap-up going on with the Cardinals today to see if we can sweep that series. We beat the Cards rather badly the last 2 games, so I would not be disappointed to eventually run into the St. Louis Cardinals in the World Series, although, truth be told, I am hoping for a Baltimore-Milwaukee with Hank the Wonder Dog. I am enthralled with the Milwaukee Brewers and the story of that rescued puppy this year. So, but the hottest team in the game, and everybody got to watch out for this one, I picked earlier this year and was heavily criticized, took some flack from my friends up there in Detroit. I picked Kansas City to win the division because of all the great young talent and arms that they have on that team. And I figured Detroit, with a new manager, a couple years of just coming right to the verge of winning everything, they were going to have a letdown. Hasn't happened, but they haven't been as good as they were last year, and Kansas City is on fire. Winning 9 of their last 10 games. If Detroit even blinks here, Kansas City's only a game and a half out in that Central Division. If Detroit blinks, Kansas City is going to win that division, much to the dismay of all the Detroit Tiger fans out there. Of course, NFL preseason started this week. Who cares? Let's move on. There's not really much to talk about there. The fact that the Ravens offense looked good for one drive does not mean that they're going to look good all year. We got to get into September and see what happens there. Now, not much exciting coming out on the book front in this week coming up. But guys, I let you down last week. I missed a couple of fantastic books that belong. If you're a recreational reader like I am, and I read a lot, both for business and professional purposes, but it's also my favorite form of entertainment. So, Preston and Child came out with a new Gideon Crew novel. These are good, solid novels. They're not as good as their Pendergrass series, which is just one of the just best as far as I'm concerned. Incredibly well written, great characters. But the Crew novels, solid read, good time. They came out with a new one of those last week, so you should probably pick that one up. And then William Lasher, who writes legal and financial novels, has written a new novel featuring his character Victor Carl. Appears he's fallen on some bad times in his acting as a bagman from some unsavory characters. But anyway, that's a great, solid series. If you like legal thriller types books, you want to go back and get that one. Then the scheduled publication date of Tobias Carlyle's Deep Value has been moved up to August 18th. Originally, I was told it was going to be out in September, but should be out not this week, but next week. Make sure that's on your reading list. Tobias has done some phenomenal research in the past. I've mentioned and recommended his first book with Wesley Gray, Quantitative Investing, several times. I keep a copy pretty close at hand here in the office because it's got some fantastic data and information in it. He does a thorough job of researching markets and using statistical analysis to figure out exactly how to come at making money in this thing. Book will be out on August 18th. Make sure you pre-order it on Amazon at your local book dealer. All right, busy week coming up this week. We've got the Small Business Optimism Index will be out. We have the headline number for retail sales. That's always such a fascinating number. Everybody puts a lot of weight on that. I don't think it's that good, but I've been wrong before, and I'm certainly not going to make any bets in advance on it. I don't think it's that great out there in retail land, but we'll see what the number says. We will find out this week what the Chinese want us to think that Chinese industrial production has been. I put no faith or trust or belief of any sort in the numbers coming out of China because I frankly think they make them up to suit their own agenda. But we will see what they want us to believe at some point during this week, and folks will trade in and around on that information, so could be a market mover. Probably won't move the markets, but the Detroit bankruptcy hearings start this week. Not going to be a huge market mover, at least initially. Long term, some impact in the municipal bond market possibly, but it is going to be fascinating and worth paying attention to. This is one messy financial situation. We do have a couple big retailers out with earnings this week. Earnings season starting, thankfully, to slow down. You got Walmart, Kohl's, Nordstrom, and J.C. Penney will all be out with their numbers. Be some big economic tells in that as we're getting up and ready for the back-to-school season. We have the University of Michigan Consumer Sentiment Survey. That's always a potential market mover. I suspect it's down. Just been too much going on in the world. We've seen too many bad housing and retail reports to believe that consumers are walking around smiling and happy. But again, my predictions are worth about as much as anybody else's on these types of things, which is absolutely nothing. So let's wait and see what the number is and if it moves the market in either direction. And we also get U.S. industrial production, a little bit more faith in how our government calculates the numbers. So that should tell us a little bit about what's going on in the economy out there. You'll notice I didn't talk about community banks yet this week. Guys have talked about them every week. If you're not in this trade, you're allergic to money. Jimmy Rogers, the author of The Investment Biker and a few other books, nice fellow from down in Alabama, always said that he never liked to invest until he saw money laying over in the corner. He could just walk over and pick it up. That's the situation that you have here. Community banks, still lots of them on sale. You can find plenty of these quality little banks trading at 80, 85% of tangible book value with equity to assets ratio in excess of 10, loan losses and non-performing assets less than 2% of total assets. So just great little banks in sound shape. Insiders are buying. There's activist funds in there pushing these banks to merge, consolidate, and unlock shareholder value. This is a tremendous opportunity. It's going to go on for years, and there's going to be a lot of money made in the community banks. if I haven't convinced you by now, I don't know what else it's going to take. But you should go to, and I'll just give you my little blog website, www.timmelvin.com. There's a couple links there, and sign up for Banking on Profits so you can join us in making the money that's going to be made in community banks. Remember, so far, 1 year, 5 takeovers, average gain so far is north of 50% on those 5 takeovers so far. Pace of deals is accelerating. We're going to be a part of it. I'd like you to be a part of it too. So hop over to the website, dig around a little bit, look, see what you find, click the link, sign up, and let's make some money. Anyway, that's it from down here in Central Florida. It is not a sunny afternoon, unfortunately, so perhaps I'll grab a book and go watch the Orioles finish off the Cardinals and then perhaps take a Sunday afternoon nap. We'll talk to you guys next week.